Good evening to all of you.
Good evening.
Welcome to our class for today. So, the last time we met, I guess we were discussing on cash management, okay, on how to manage cash. And we did introduce one of the model. We did prepare a cash flow forecast, okay, as well as we also went ahead and discussed on how we can use the Baumol model, okay, that is the EOQ model, assuming that cash is gained or cash is considered like inventory. So today, I want us to discuss on the use of the Miller-Orr model. Now, I think we did make an introduction last time, but either way, let's reintroduce the model again. This is one of the key drawbacks of the Baumol cash management models was that there are a number of assumptions that we do make that might be unrealistic. Okay, there are some assumptions that generally, in reality, they don't apply. And one of the key drawback of the Baumol model was that we assume that there is constant consumption of cash. Okay, if the company is in need of cash, then we assume that every week or every day or every month, the cash consumption is the same throughout the year. Okay, which in reality, that might be the case. Okay, there are times when the company need for cash is going to be greater than other times. Okay, there are some certain periods of the month when the company excess cash is going to be greater than what the company is than what the company wants. Okay, there'll be times when the company cash need is greater than other times. Okay, so because of that fluctuations, okay, that the cash balances is going to move up and down depending on the cash generated, depending on the cash consumed. Okay, the reality is that cash balances will be moving up and down. Okay, so in the Miller-Orr model, the idea is that we want to put restriction to those movements. Okay, we want to ensure that we can be able to, in quotes, limits those movements. Okay, that the movement, the cash balance should never go above X amount. Okay, the cash balance should never go should never go below Y amount. Okay, so the Miller-Orr model said it is false. The cash in reality can move up and down. However, we want to put restrictions to that movement. Okay, having a maximum balance, having a minimum balance. But if the cash balance are in between those two limits, the upper limit and the lower limit, then in quote, the problem is not that huge. Okay, the issue comes in if the cash balance go below the lower limit or the cash balance goes above the upper limit. Okay, so what you want to establish the model is to be able to tell for a particular company what is its maximum cash balance. Okay, what is a minimum cash balance they have to be having. Okay, and generally, don't forget the company will be aiming to have what referred to as the target cash balance. Okay, where the cash balance ought to be at. Okay, that the cash balance should not go above given limits. Okay, the cash balance should be where we target the cash balance to be at. Okay, what we call the return point. Okay, so generally you have the lower limit, we have the return point, and we have the upper limit. Okay, so the cash balance should never go below the lower limit. Okay, the cash balance should never go above the upper limit, but generally, okay, the cash balance ought to be at the return point. Okay, the cash balance ought to be at the return point, where the company aims is cash to be the cash balance to be at. Okay, what we shall be referring to as the target cash balance. Okay, generally, okay, don't about the formula. I'll come back to it. Just representing a graph. Okay, we will see that the cash balance should be. Okay, we'll see that the cash balance should not be above the upper limit. Okay, the cash balance should never be below the lower limit. Okay, so those are the limits I was talking about. Okay, the cash balance should never go up above the upper limit. Okay, that is the maximum cash balance we want to have the cash at, as well as the cash balance should never be at the lower limit. Okay, where the cash balance should not go below it. Okay, but generally the company aim is to have the cash balance at the return point. Okay, what is going to be referred to as the target cash balance. Okay, the return point or the target cash balance. Okay. Now, generally, let me just open my board here. Okay, to explain more. Okay, we'll see that the cash balance, we aim, or the company aim is to have the cash balance between the lower limit and the upper limit. Okay, so that's the lower limit, that's the upper limit, and that's the target cash balance. Okay, and you see that generally the cash balance is moving up and down. The idea is that the cash balance should never go above the upper limit. So in case that happens, the cash balance approaches the upper limit, then of course we introduce it back to the return point. Okay, so just to put here, this is the upper limit or the maximum cash balance. This is the lower limit. This is the target cash balance. Or referring to as the return point. Okay, if the cash balance goes below the target value, for example, the cash meanders towards the lower limit, ensure that it doesn't go below the lower limit. It doesn't go below the lower limit. Okay, if that happens, the cash approaches the lower limit, we then need to increase the balance. Okay, we need to boost the cash balance back to the return point. Okay, back to the return point. Okay, and how did this happen? Don't forget here, we as a company, we have more cash at this point in time. Let me just put a different pen. At this particular point, the company has more cash than they need. So you need to reduce the cash balance from the upper limit back to the return point. Okay, how do you reduce the cash balance? By buying, okay, from the buying of a money market instrument. Okay, the money market instrument, the so-called the marketable securities. Okay, if the cash balance goes towards the lower limit, then company we need to boost the cash back to the target cash balance. Okay, so we need to increase the cash balance from the lower limit back to the target cash balance. Okay. By sale of here, you want to increase the cash balance. So you dispose of your previous investment in the money market instruments. Okay. So here we need to increase. So here, sale of marketable securities. Okay. That's how we will be boosting the cash balance back to the target cash balance. Yes, market.
My screen is blurry.
Okay. Is it the case for all of you?
But
no. Mine is clear.
Yours is clear.
Yes.
Mine is clear.
Okay. Wait, Margaret, what could be the problem? Could this be your network? Could you check your network maybe?
all right, so
Okay.
thank you.
Okay. So you're going to increase the cash balance back to the target or the turn point by through the sale of the money market instrument, by selling your previous investment you made in the money market instrument. Okay. We notice that the difference between the upper limit, okay, the difference between the upper limit and the lower limit is called the spread. Okay, it's called the spread. This is what referred to as the spread. Okay, the spread. Now the spread is given us, okay, or it is influenced by we call it three factors. There are three factors that do influence the difference between the lower limit and the upper limit. Actually, just to begin with, the lower limit it's you have to set. Okay, you can set it from your experience, the past. Okay, how has been your past cash consumption? Okay, for example, in the past you will be consuming 10,000 per week, for example. Okay, then you can decide to put 10,000 as your limit, as your lower limit. Okay. So it can either be a zero or based on your past experiences, okay? So you can decide to put the lower limit based on your past experiences. So no formula for that, okay? So the difference between the lower limit and the upper limit, okay, or the upper limit is going to be dependent on the lower limit and some other factors, okay? One of them, of course, is the transaction cost, okay? The cost of transaction. Don't forget, as we have said here, okay, when it comes to buying of securities, when it comes to the sale of securities, then you have to pay. Don't forget, if you're going to use a broker, or even if you're going to be the one who's going to do this transaction, there's a cost you paid for it, either in terms of your time or either in terms of the employee you do employ to be buying this money market instrument. If you use a broker, the brokerage fee you paying to this broker, okay, to buy for you this money market instrument, okay. So you'll be making a payment. So if, for example, the fee you pay to these brokers is high, the fee you pay to the broker is high, would you want to be transacting, would you want to hold more cash at your hand or less cash at your hands? If the fee the broker charges you for buying and selling of the securities is high, would you want to have more cash at hand or less cash at hand?
To have more cash at hand.
You would want to have more cash at hand. If the broker charges you a high fee, okay, to buy and to sell for you securities, then a company, you'd want to reduce the transaction you make with these brokers. They would want to reduce the number of transactions you make with these brokers. So that implies, therefore, you can be having the fewer transactions with them. Okay, therefore, the higher the fee the broker charges you, the more the cash you'll be holding at hand. Okay, as in quote, you fear to incur the transaction cost. Okay, so there's correlation is direct here. Okay, the higher the fee, the higher the spread. The more cash you'll be having at hand. The other factor that do influence the spread of the deal to the upper limit and the lower limit is the variance of cash flow. Okay, variance of cash flow. Let me do a graph so that to draw the point home. Okay. Now assume that we have two cases here. Okay. So this is cash balance. Okay. Across time. You have another case here. Then you have this, how the cash balance is like. Okay. They move up and down. Then you have the case. So this is scenario A. Here is scenario B. So between the two, okay, definitely, if you have to, don't forget, what is variance? Simple variance is how the variable, the number of the units, okay, of variables from the mean, okay. So then that's the variance, okay, squared, okay, it's deviation squared, okay, it's deviation squared from the mean. Now, of course, definitely, the number here, if we have to say that this is the mean, for example, just allow me to draw this to be the mean. It's not the mean, but just for our own argument here, assume that this assume that that's the mean. Okay, the same for the two graphs here. Okay, now between those two graphs, okay, where is the volatility? Okay, because variance is simply how volatile, okay, are the returns, how volatile are the cash flow in this example from the mean. Between A and B, where do you have more volatility?
A.
Of course, if we have A, okay, that A has more volatility, that the risk, definitely, therefore, the risk in A is high, okay, of course, the more volatile returns are from the mean, definitely the higher the risk, okay, that here the returns are high, the cash flow in this case is much more higher in A compared to the case of B, okay. Now the question is, if time, assume the time here is days, look, this is a cash quantity, this is a quantity of cash, and this is time, okay, and so the time is in days. Now, between scenario A and scenario B, where would you want to hold more cash as a company?
Scenario A.
Definitely, you want to hold more cash in scenario A. Why? Because in scenario A, the risk is quite high. It's like inventory. Okay, if the demand is very uncertain, there's some day when the customer can buy from you 2 units. Some other time, the customer can buy from you 100 units within the same day. Another time, you are sure the customer is going to buy from you 10 units throughout the week. Now, definitely, you are looking more stock. Looking more stock where there is more risk, where there is more volatility. Therefore, in A, therefore, you can have, therefore, companies will be holding more cash. Okay. Therefore, the higher the volatility, okay, variance of cash flow, the higher becomes, therefore, the spread between the lower limit and the upper limit. So, therefore, there is direct correlation between the spread and the variance of cash flow. the volatility. Variance is a measure of how volatile the variable is, okay, from the mean. Okay. The other factor is interest rate. Don't forget, as we said here, once you buy the securities, you get an interest because you're buying the money market instruments. Okay, if you invest in government treasury bills, the government pays you interest. Okay, now in case the government is paying you interest, okay, the government is paying you interest for the investment you make of them. Okay, if the interest you're paying, the government is paying you, okay, for investing in those money market instruments is high. If the interest is high, would you want to hold more cash at hand, or would you want to invest that cash?
To invest the cash.
Invest the cash. Okay, which means therefore, if the interest that is being offered by the government is high, then you want to have more. You would want to have less cash. Therefore, the spread becomes lower. Therefore, there's an inverse relationship between the spread and the interest rate. Therefore, we divide. Therefore, here, because of that inverse relationship, we divide by the interest rate for the period. Okay. Then to complete the formula, this is a stochastic model. So don't worry, so 3 over 4 times the 2, we get the cube root, then you multiply by 3. Okay, and that's how we get the spread. Okay, but I was trying to explain how the spread comes about. But anyway, that's how we get the spread. The difference between the lower limit and the upper limit. Okay.
Excuse me, sir.
Yes, that's Michael.
Yes, yes.
Yes, ask.
Could you repeat your explanation for interest rate? You are breaking on my end.
Okay.
Interest rate.
Now, if, for example, you are to invest on this money market instrument or government issued bills or even commercial papers, if you're going to be given by the issuer, by the government, high interest rates, the government is offering you high interest rate if you're to invest in those treasury bills. Now, would you want to invest in those government bills, or would you want to hold the cash in cash form? Question. Michael, what would you want to?
I'll want to invest in them.
Then definitely you don't invest them. Then in case you invest in the government bills, what about the company cash balance? It reduces. Therefore, the spread therefore is going to be,
yes,
in case the government is offering you high interest rate. Therefore, there is the inverse relationship. The higher the interest being offered, the lower becomes the spread. Do you get it?
Yes, I do. Yes, I do.
Yeah, that's what you can say. Therefore, there's an inverse relationship between the spread and the interest rate. Okay. Once you have the spread, then to get the other things becomes very easy, because don't forget, the upper limit is the lower limit plus the spread. But the difference between this point and this point is spread. Therefore, the lower limit, then therefore the upper limit. I just go to the next slide. Therefore, the upper limit, and like you've already seen, just a new one. Therefore, the upper limit is giving us the spread for the lower limit. Okay, spread plus the lower limit plus the lower limit. And the return point or the target cash balance is equal to the lower limit. This is the target cash balance. Let me refer back to the graph. This is the target cash balance here. Okay, again as the lower limit plus this is a third, and this is 2/3 of the spread. Therefore, plus a third of spread. Okay, back plus lower limit plus a third of spread. Then we just calculated. Okay. So if the cash, just to refer back to our graph, okay, allow me to rub off some of these things here. Therefore, if the cash balance, just repeat, if the cash balance, if for example, let me just put figure to it. This is 200, so this is 225, and this is 275. Okay, just hypothetical cases. If the cash balance if the upper limit is 275, and now the cash balance is at 275, and so the cash balance is now at 275, we are here at this point, then we need to reduce the cash balance back to 225, the turn point. Okay, How do you do that? By buying money market instrument. What's the difference? In this case, therefore, the difference is 50,000. Therefore, we need to buy securities worth 50,000 so that we can reduce the cash balance from 275 back to 225. If the cash balance is at 200, okay, at this point, for example, okay, then of course we need to increase. We need to boost the cash balance back to its target cash balance. Okay, in this case, 225. And how do you do that? You need to sell, okay, securities worth the difference. In this case, worth 25,000. So they can boost the cash back to 225,000, the target cash balance. Clear? Okay, if that's clear, and that simply is our cash, is our Miller-Orr model. Okay. You don't, but if you do one time, second time, third time, you apply this model, it becomes easy. So you don't even need to sort of like cram this formulas. You don't do that. Okay. Okay, I guess having discussed. Yes, yes.
Okay, would you mind repeating what you meant by where we getting the 3/4? Like, how are we getting?
No, because this is I don't want to go to the part of derivation because this is stochastic model. It's a stochastic model. That's why I don't want to go back to the math behind it.
Oh, okay, okay.
Yeah.
So we need to get the formula as it is. That's how it is.
That's how it is. Yes, that's how it is. Yes, that's how it is.
Okay. Yeah.
Was that shallow now? You don't know because I can see.
Yes.
Okay. Having done that, I guess we can do an example. Okay, so go through this, then we discuss together. Okay, once you have the spread, of course, you have the other becomes quite easy. Upper limit, therefore, may be equal to the lower limit, which was 8,000 plus the upper limit plus the spread, 25,303, and you get 33,303. To get the target cash balance, the return point, is still lower limit, 8,000, plus that was spread, 25,303, and you get 16. Return point.
You get 16,434.
16,434 dollars to be the return point. So the company ought to be having the aim to have the cash balance as 16,434. Then the cash balance will never go above that 3,303. Simple as that. That's how you manage.
Hello, sir.
Yes.
I have a question.
Ask.
The 3/4.
3/4.
Is it a numerator or it? Yeah. Should it be the new part of the numerator or it's we multiply the whole transaction?
It can go anywhere. There's no difference. It can be numerator. There's no difference.
Oh, okay.
Yeah.
Okay, thank you.
Okay. And that's how you manage cash using the Miller-Orr model. So in case just also use the graph. Okay. So the graph, just to draw it here for this question, for example, the lower limit. Okay, so in this way, the target cash balance is there. Upper limit is there, and the target cash balance is there. Okay, just use the figures you've calculated. Here we got 3,303. We got 20. We got 16,434. And the lower limit was 8,000. Okay, So in case the cash balance reaches the upper limit, then we need to sell security. We need to buy securities. Worth how much? If the cash balance reaches the upper limit, okay, how much of securities should you be buying in the market? If the cash balance reaches the upper limit, what's the worth of the money market instruments or the marketable securities we buy so that you can reduce the cash balance to the back to target cash balance? What's the worth of those securities?
It is 16,869.
16,869. Don't forget to increase the cash balance back to target. So this difference, you go 16,809. 16,809. Michael, help.
869. 869.
869. So therefore,
69.
869.
Yes.
Therefore, in this case, you need to buy securities worth 16,869. So you can reduce the cash balance back to the target cash balance. Okay. If the cash balance approaches the lower limit, okay, then we need to boost it back to the return point, the target cash balance. Okay. Through you need to, how do you do that? Okay, by selling, by buying. No, in this case you need to boost the cash balance. So this is selling. Okay, so this is therefore here is going to be a sale. So this is going to be a sale of money market instrument worth the difference. Okay, which is 8,8434.
Yes.
It was 8,434. Simple that. That's how therefore you'll be managing your cash balance. But as long as the cash balance is in between the upper limit and the lower limit, okay, then the concern in code is not that huge. Okay, if the cash balance is always in between these two, okay, it doesn't go above the upper limit, the lower limit, then the concern is a bit low. Okay, but in case, but you can still reduce it back to the target cash balance. Okay. Anyway, so Sharon, you had a question.
Yes, I wanted to like you go back. I see how you calculated the target.
The target.
The target point, yes. The return point.
Now the return point, it's the lower limit plus a third of the spread.
Oh, okay.
Yes. Okay. Now let's check what your examiner has tested on that area. Because he has. Okay, so I'm going through the question bank just to see question your examiner has tested. Yeah. May 2018, question 1C. May 2018, question 1C. Okay, go through it. We discuss together. May 2018, question 1C.
Excuse, sir.
Yes, yes. Michael. Michael,
Could you repeat the question?
May 2018, question 1C. May 2018, question 1C. Okay, so in this question, the examiner is asking you, using the Miller-Orr model, determine the optimal cash balance, that is target cash balance, the upper limit, average cash balance, and the spread. Of course, the way they have been arranged there doesn't make sense because you can't get the optimal without getting the spread. So of course, we begin from the fourth requirement. We need first to get a spread. And as I mentioned, we have to be very careful on how the values has been given, okay? But the time need to be the same for the interest rate as well as for the case of the volatility measure. Now here, we were told that the standard deviation is daily, so be careful, this is daily standard deviation, which means that for the interest rate we're going to be using need to be daily interest rate, okay? It need to be daily interest rate. So yeah, be very careful. Now this is per annum, so you need to convert it from being per annum to a daily interest rate by simply dividing, okay? Now we know those variables, we can simply, therefore, get the spread. Begin by getting the spread, okay? The spread will be equal to 304 times the cost of transaction, and the cost per transaction will be told is equal to 20 shillings, okay? So 20, we multiply by the amount or the variation of cash flow, which is equal to 2,000. Look, this is a deviation, so we need to convert it to variance by squaring, okay? We divide by the interest rate, the daily interest rate, so this is 0.092, but this per annum, so we get to daily by dividing by the number of days in a year. Therefore, we divide by 365, isn't it? Yes, 365, and we get the cube root. And we get how much will be the spread?
$21,575.
We get 21,475.
575.
575, therefore the spread is 21,575. I think that maybe the key concern there was simply how to convert that the two need to be, this is daily, the variation, and therefore this needs to be also on daily basis. That's what we have to be quite careful, okay? Otherwise, everything else remains the same. It will be quite simple and straightforward. Once the spread, to get the thing comes quite easy. Upper limit is the lower limit, okay? The lower limit is given to us as equal to 10,000.
Yes.
Plus the spread, and the spread is 21,575. Therefore, this gives that 1,575. The return point or the optimal cash balance, the target cash balance is the lower limit, 10,000 plus a third spread, and the spread is 21,575. To give us
17,192.
17,192, and therefore the return point, okay, or the auto cash balance. Then you meant to get the average cash balance is given us 4 times the return point. Maybe there's another formula which I think you don't have, minus the lower limit. We divide by 3. Okay, so I don't know whether these formulas you need to cram them or what, but generally once you do 1, 2 example, they become easy to do, okay? So 4 times the return point, okay, minus the lower limit, we divide by 3. So 4 times the return point we have it here, 17,192 minus the lower limit, which is 10,000, we divide by 3. So on average basis, how much cash does this company have if you were to use the Miller-Orr model?
19,589.
19,589.
Yes.
Okay, so therefore, the average cash the company will be holding at any point in time. As you can see, it will generally be above the return point. Okay, as you can see, the return point for this company is 17. Okay, there's no way it can be above the upper limit. The upper limit is how much? Towards that 1,585. Okay, and no way can be below the lower limit of 8,000 of 10,000. So it is in between the upper limit and the lower limit. That is the average. Okay, on average basis, the amount of cash the company will be holding. Okay. Of course, we have once you have in case you have the formula to apply, it's very easy and straightforward. Okay. Question? Okay, there seems to be no question. Maybe just the last one. There's another question I've seen here. Okay, I think it was May 2016. Let me see if that's the case. May 2016. I think I've seen a question there that is asking us to apply the model. May 2016. Yeah, it is. May 2016, question 3B. May 2016, question 3, part B.
I'm getting 162,523.
So minutes, you get it? 100?
And 62,523.
523. Okay. Someone else that has a spread?
I'm getting 161. 777.
Okay, 161,777. Someone to collate the answer?
I'm getting what Sharon got.
162,523.
Yes.
Okay, fair enough. Okay, let's attempt together because once you're the spread, the other is very easy. The upper limit, the return point. Okay. So here we've been told that the company has the standard deviation. Okay, is 22,000. The cost is 60. The interest rate is per annum. So of course we need to convert it from per annum to daily because the standard deviation is daily. Okay, which will be equal to 3. To be equal to 3 times 3 over 4 times the cost of transaction, which in this case is 60 times the variance of cash flow. So we square standard deviation 22,000. This is not working too well. Get a better screen. I hope your talk will be better. So be equal to 3 times 3 over 4 times the cost of transaction, which is equal to 60 times standard deviation times the variance, which is standard deviation squared 22,000. Okay, squared. We divide by the interest, this per annum, so we convert from per annum to per day. Okay, to daily. Okay, so 0.05 this per annum divided by 365. Okay, now all this need to be, we get the cube root, the power of, okay, the cube root, then you multiply by 3. Okay, I don't have a calculator here. So what do you have there, I guess, once you apply the formula? What's true?
Yes.
Okay, so we get 162,525 to be therefore our spread. Once you have the spread, of course, simply apply the formula. We get the upper limit, which is going to be the lower limit plus the spread. Okay, so the upper limit is going to be the lower limit, which is 2 million. plus the spread, which is 162,523, okay, to give us therefore 2,162,523, okay. The return point is lower limit 2 million plus a third of spread, and the spread here is 162,525 to give us 2 million and how much? 2,050,000.
54,174.
174. You get 2,054,174 become therefore the return point. Okay. Simple that applying the formula. Okay. Yes. So those are the two models. Okay. The Bowell model, which I think we discussed last time, and the Miller-Orr model, cash management models. Today I want us to discuss on forecasting. Not sure if I've done that. How to forecast working capital need. Have we prepared a statement of working capital requirement? How to forecast working capital needs and prepared a statement of working capital requirement. Have we done that?
No.
No.
We haven't.
Mm-hmm.
Okay, if we have not done, then maybe that is the next thing that we can discuss together. How to forecast the working capital requirement. Don't forget, sometimes can have a case where the company want to determine that in the next one financial year, in the next 6 months, for example, if we were to achieve certain set of numbers, okay, we don't, for example, give a customer 2 months. We don't, for example, we are going to negotiate with the supplier to give us 3 months of credit, okay. The days for material will be X number of days, okay. Now, if the company has a target working capital cycle, let me call that way. Okay, the company has a target working capital cycle, that is the days for inventory, the day for receivable, the days for payable. Now, they want to estimate that how much must they be invested towards each of the working capital component. How much they need to invest towards inventory. How much they need to invest towards their customer, that is the receivable. How much they need to invest therefore in payables, okay? All that based on those forecasts, okay? Can we prepare what we call a statement of working capital? You tell me therefore how much money as a company in the next one financial year do we require if we are to achieve those number of days? Okay, what is our working capital need in the next 6 months, in the next 1 year? Okay, the best way is to do a question, okay, from your examiner. Because I think the formulas you have there, okay. How do you get the number of days for receivable? Okay, how do you get the days for payables? How do you get the day for inventory? We have those formulas. Now it's about working backward to get the investment in the receivable, investment in payable, investment in material, investment in work in progress, investment in finished goods. Okay, based on the days for each of those accounts. Okay. So I think the best is to do a question. So let me go through back to the question bank. Okay. So, no, I think this is one of them. So I can't find a question. How comes? It's quite unlike. Anyway, let's see if they can get one. Okay, no, I think I'll have to give you a note question because it seems that this question, we don't have any listening questions asking us to determine the company working capital requirement. Quite surprising. Wow, okay. So give me a minute as I look for a question from the old paper. Okay, I've seen a question here from May 2014, which I think I need to share with you on the WhatsApp group. So I'm sharing a question here with you. So check it out, then it's not so clear. Hope it will be clear to all of you. So let me share it with you. Okay, so I've shared a question with you. So go through it, then we can attempt it together. This is from May 2014, question 5B. Okay, I presuppose that you have gone through the question and you have understood what the exam requires of the student then. So here you need to prepare a statement of working capital requirement, okay? And you've been given some data there, raw material, work in progress, finished good, days for suppliers, that means that we need to get the payables investment, days for data, that means therefore we shall use it to get the receivables investment. Okay, and that is it. Okay, so let's begin by getting the raw material investment. Raw material investment. Okay, simply using those formulas, which I think we have been so conversant with by now. Okay, the raw material investment to be equal to days for raw material. We divide the number of days in a year. If they're in month, we use month, and I think in this case they're in month, so we use there for months, 12 months. We multiply by raw material purchases. Okay, raw material purchases. I'm just using those formulas, okay, and making the raw material investment the subject of the equation. So raw material purchases. Yeah, well, there we go. The number of days for material as per note 1 is 2 months. There were 2 months out of 12. We multiply by the purchase for material for that year. We'll be told that the cost per unit, the raw material cost per unit is 200. And in a year, this company is producing, how many units is producing? 30,000. Producing 30,000 units. Therefore, the raw material investment the company requires, therefore,
$1 million.
1 million. So the company therefore need to invest 1 million if it is to achieve those number of days, the 2 months. Okay. The next working is work in progress. Now, work in progress, will be told that it is 100% complete material, 50 for labor, and 50 for overhead. Okay, that's the internote. The days for material will be told is equal to half a month. Therefore, it's half a month, 0.15. It's half a month. Divide by 12 months in a year. We multiply by the cost of production. Okay, the cost of production. Okay, just can put a small note here. Then you can do working for that. The cost of production for work in progress. Okay, for the work in progress.
Excuse me, sir.
Yes, yes.
Okay, what do they mean by half month? Is it like a half, like 6 months in a year or 15 days?
It's half a month.
So that's like 15 days.
Okay, yeah, but the best thing, don't convert them into days. If you're given month, use month. If you're given weeks, use weeks. Don't convert them into days, otherwise you're going to be a bit confused along the way. So I propose that if they're month, use month. That's the way they're given. If they are given weeks, use weeks.
Okay, fine.
Yeah. Okay. Therefore, the work in progress is 100% complete towards material. So we have here material. And material you're seeing is the cost is 200. For labor and overhead, it's 50%. Therefore, for the case of labor and overhead, for labor it's half. Therefore, it will be 0.5 times the cost for labor for a unit is 50. So half of 350 to give us 25. For overhead, it's also half. 0.5 times the cost per unit for the overhead, which is 150, to give us 25. To give us therefore the cost of work in progress so far is therefore equal to 300 units per 300 shillings per unit. Then therefore the total cost of production therefore total cost will be the cost per unit 300 times the units, which in this case is 30,000 units, to give us how much? 9 million.
Yes.
9 million. Therefore, work in progress investment 0.5 divided by 12 times 9 million, to give us how much?
$375,000.
And you get 375,000 to be the company investment they'll have to make in work in progress. Okay, that's for note 2. Note 3, finished goods are in stock for 1 month. Okay, for 1 month. Therefore, we're going to get the finished goods investment. Okay, and see they're finished, it means that they're finished 100% finished towards material, towards labor, and towards the overhead. So they're 100% complete towards, because they're finished already, either way. Okay, so for next working, to get the working, it's the finished good investment. The finished goods investment, the number of days for finished goods. Okay, therefore days divided by 12 months. They are given a month. Don't convert. Don't. You can convert if you want, but why do that? Okay, so multiply by the cost of sales. The cost of sale. Okay, so that's what we do here. The cost the company seem not to incur any selling cost. So either way, it is simply the cost of production. The cost of sale will be material 100%. Okay, you don't need to work in for that. It was already given there. Material 200, labor is 50, overhead is 150 to give a cost of 400. There's no cost of sale. So simply therefore you can say therefore total cost of sale, total selling cost, total cost of sale, not selling cost. Total cost of sales therefore be equal to 400 times the units, which in this case remain at 30,000. Give therefore 12 million. Therefore, the number of days as per note 3, it's 1 month or 12 times 12 months, 12 million, to give us therefore 1 million, I guess. Yes, 1 million with the company investment towards finished good. Clear? Okay. I hope silence means that you do agree. That's for the inventory, raw material, work in progress, and the finished good. Next, we can do the payable as per note 4, it's payable. So the company, the amount the company will be owing the supplier at any point in time is the payables days. When you do a 12 months, we multiply by the total company, the total amount the company purchases from them, total credit purchases. So we're going to make an assumption here that raw material, labor, and overhead, they are all on credit, okay? And the 3 suppliers for material, suppliers for labor, suppliers for overheads, all of them are part and parcel of the suppliers as per note 4. That's the assumption we're going to make, okay? Therefore, in an year, the total purchases, total credit purchases, if anything, you're going to assume is equal to the cost of sales, is equal to, we have it here already, is equal to 12 million, which is 400, the cost per unit, you multiply by the units in a year, okay? As for note 4, you give suppliers 1 month also. So 1 month, they give you 1 month times 12, times the total purchase we make to them on credit to give us also 1 million, okay? Then note 5 is on debtors, therefore receivable investment. The amount that we invest in a customer is the number of days we give to them, 2 months, out of 12, times the sales we make to them on credit. We sell to them 1 unit for 500, and we sell to them 30,000 units in a year. Therefore, how much do we invest in a customer? Or how much the customer owes us at any point in time during the year?
Excuse me, sir.
Mm-hmm.
Excuse me, sir. I have a question before we move on. why are we saying that the credit purchase is the cost of sales? I would think that the credit purchase should be the cost of materials, because those are the materials you purchased from the creditors, which are due to pay.
Now the question is that are suppliers, are employee part of your, are these part of your suppliers?
No. Employees, no.
What does the employee do to the company?
The employees help in the manufacturing process.
Okay, therefore, they provide you with their service, isn't it?
Yes.
With you, therefore, they're like sort of also part of suppliers of service. Aren't they?
Okay.
Yeah, from that context, the employee, they supply you with service, because either way, what they do is they give you their hours, and in turn you pay them. They are your suppliers because you pay them, isn't it? But in this case,
So I
service.
think I understand what you're saying when I think of it as we are calculating the payable. So it's just in general the total amount which the firm is to pay. Yes.
The firm is to pay the employees, the supplier for raw material, supplier for electricity, suppliers for water. Yes, this is combined wise.
I've understood. I was just confused because I saw the word credit purchase, but I've understood.
Okay. You then get how much for the receivable? 1 million, 1 point?
Actually, it's 2.5.
It's 2 point. Okay. 2 point. 2 million, 2.5.
Yeah.
Okay, 2.5. Give me the company will be investing in their customer 2.5 million at any point in time. Now, having done that, you can prepare the work. You can prepare therefore the current assets and current liability, because you have the figures. Okay. Therefore, you can prepare. This company is called Rand Mill Limited. Working capital statement of working capital requirement. Statement of working capital requirement. Okay, you can begin by current assets. We have inventory, and for this company, the inventory is in raw material. So you can have here raw material, and from the working raw material, we got how much? Go back to our workings. We got 1 million. So 1 million for raw material. So here's savings 1 million. Then you have work in progress. The amount the company will be investing in work in progress, 375,000. Then you have finished goods. Finished good, we have it here, 1 million. Then you have receivable, which you got 2.5 million. We got cash, don't forget, cash is part of it as per note 6. We have cash is 250,000. Again, the total current assets. Then you have current liabilities, we less current liabilities. In this case, we only have one, the payables, nothing else. I don't get anything else. Payables, which from a calculation we got payables, we got 1 million. So we less 1 million. Sum total, we less 1 million. Then we have here net working capital required. Net working capital, which is how much?
4,125,000.
2 million.
4 million.
4 million. Sorry, we'll get this. 4 million.
125,000.
25,000.
Yes.
Okay. I'll call it for company net working capital requirement if they are to achieve those number of days. Okay. So therefore, in the coming year, the company to look for that investment. Okay. Someone who is going to be willing to finance the company 4,125,000. Okay. Maybe last question. Once I can get another question. I've seen another question here from a 2011 city. I'll share the same way. They are sitting for 2011. Okay, so I've shared with you. So this is June 2011. June 2011 question 4C. So June 2011 question 4C. Attempt it fast. So there are 10 marks, so I'll give you 15 minutes. June 2011 question 4C. Okay, I presuppose that you have gone through the question. What do you get for those who have completed? Michael, what do you have? Michael, not yet. Sharon?
Not yet.
I'm filling my statement right now.
Okay. Joseph?
Yes, sir.
What do you have for working capital?
Okay, me, I'm still quite far from finishing.
You are quite far.
Yeah.
Okay. Immaculate?
Saya bado.
Okay. Okay, so I'll give you 2 minutes. Okay, let's attempt together. Let's now attempt it together. Confirming the workings that you've done. So allow me to use the Excel so that I can have the solution. So I can save it. So if we begin, let me begin, because the requirement is compute the working requirement for the company, assuming a 50-week year. Okay. For this company, it has work in progress, it has raw material, it has finished good. I think we can begin there. We get the raw material investment. Okay, so we can begin by getting raw material investment for this company. So raw material, which of course is giving us the day for material. Okay, days for material. In this case, they are in month as per note 1. So we simply divide by 12. And of course, we multiply by total material purchases. Okay, raw material purchases. Raw material purchases. Okay, that therefore is going to give therefore the company investment towards the raw material. Okay. Therefore, the day for material is in stock. The raw material are in stock for 3 months. So 3 out of 12 we multiply by the total raw material purchases. Material purchases, they represent 30% of the company turnover. So therefore, they represent 30% of the company turnover. The turnover is equal to 15 million. So times 15 million. And you get how much to be the company invest in raw material?
1,125,000.
So 1,125,000. I have my calculator, so I can confirm that. Okay, so 1,125,000. Yes, we get 1,125,000 to the company investment in the raw material. Okay, then the same process for work in progress. So a company work in progress investment will be days for work in progress. We divide by, okay, days for work in progress. We divide by, in 2, the days are given a month. Therefore, we divide by 12. Okay, we multiply by the cost of production. Cost of production. To be equal to the day for raw material as per note 2 is 1 month. So 1 out of 12. We multiply by the cost of production. Okay. And if it is work in progress as per note 2 represents 1 month worth of half processed good. So they are 50% complete towards material, towards labor, and towards variable overhead. Okay, so half processed goods. Okay, they are half processed good. So therefore they are material, labor, and overhead. Therefore, they are 50% complete. 50% complete towards labor, and labor here we've been told the sum of material, labor, and variable overhead, 30 plus 25 plus 10 to give us how much?
65.
65. Therefore, they are half of 65% of 15 million. Is that clear? They have, okay, that's why I multiply by 50, because they have processed, but they represent, but the total cost of production is 65%, but half is how it is, the extent of how they are processed. Clear? Okay, and you get how much?
Yes. 46 to 50.
46.
Yes, I
406
guess.
to 50. 406.
Yes, yes.
Okay, okay.
To 50.
Let me confirm that answer because I have the workings at least here now. Okay, so this is in million. I guess 46 to 50, as Michael said, let's get 46 to 50 the company investment in work in progress. Okay, same process for finished goods. Finished goods. Finished good investment will be equal to the days for finished goods. Okay, We divide by 12, I'm not sure, and not, yes. In note 3, the finished good 8 months, so therefore we divide by 12, okay? But now we multiply by the cost of sales, okay? We multiply by the cost of sales, okay? We multiply by not production, by cost of sales, okay? This will give us, note 3, finished good represent 1 month of production, so 1 month, okay? We multiply by the cost of production. We be told that the company's selling and distribution cost, the selling and distribution cost is 5%. Therefore, the finished good, they're finished, they're finished in totality because they're finished, okay? But they represent 70%, which is equal to material, labor, variable overhead, and selling and distribution. Okay, I hope that's clear. Okay, we have to give therefore 20% of 15 million.
Excuse me, sir.
Yes, yes.
Is it?
Not the last note. I think
Work in progress, work and finished good. Work in progress and finished good avoided the material, labor, and variable expense. Yes, 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 Michael.
I think Michael was going to say that it should be valued at 65%.
65%, not 20%.
Yeah, because the selling and distribution costs and should not be included.
Okay. Now,
I feel that's an expense.
Sorry?
The selling and distribution cost is an expense.
You're going to consider it as an expense. But that's a selling cost. Is it not a selling cost?
of course it is, but the additional information there is quite clear on what to do.
On how we meant to apply the work in progress, finished good, avoided the material.
Yeah, they're supposed to be applied in the same way. The work in progress and finished goods.
Work in progress, finished good. Now, I hope the examiner did not penalize the student who did add the selling cost, because if we're to look at it from a accounting perspective, what is the cost of sale? What's the difference between cost of sale and the cost of production? It's simply the selling cost. And since we've been given the selling cost here, well, we consider it as, oh, this is not selling cost. No, I'm not sure. Okay. And let's go as part 5, as you're saying. Let's go as part 5. As it's telling us, we should not include the selling cost, the selling and distribution cost. We can consider it as part of expense as opposed to being part of the selling cost as per se. Okay, let's go as part of that. But I hope the examiner did not penalize those students who did consider as 70% as opposed to being 65%. Either way, okay. What do you get?
It's 12,500.
Get a 12,500. That's true. It's 12,500. And therefore, the finished good investment. Okay. Now that you're done with the raw material, sorry, with inventory. Next we can do is the receivable. Okay. The next working can be on the receivable. Let me just expand this for those who want to see the markings. Yes, so that is it. Okay. So receivable. The amount the company is investing is in their customer. Is a day for receivable. Okay, days for receivable. We divide by A note 1. The days are given in months, so divide by 12 and multiply by the total credit sales made during the year. Okay, which will be equal to the days as per note 1 is 2.5, so 2.5 months times the selling cost. The total selling price, or simply revenue, the turnover. Okay, you don't need to, it's simply the turnover. We multiply by 15 million, the turnover for the year. Assume that all sales are made on credit. Okay. And you get how much?
3,125,000.
3,125,000. Okay. Let me just confirm that. 3,125,000 to be the company investment in their customer for sales made on credit. Okay, so we're done with inventory, receivable. Note 4. Note 4, this credit is taken as follow. Now here, the suppliers are, I don't know, someone was asking in the previous question, where we have different suppliers. In this case, the examiner has given you each of the suppliers for labor, suppliers for material, overhead, and fixed overhead, all the suppliers. So we need to get how much the company owes them, okay, at any point in time. So we can begin by, so this is called them payable. Yes, let me just call it payable, okay. And I begin with the first one, the amount the company owes the material supplier, direct material supplier,
Yes.
direct material suppliers. For direct material suppliers, the number of months we give them is 2 months. Don't forget the formula, I don't know where I can write it. Okay, we just write it down here. The number of days you give the suppliers, so times we do it 12. If they are in months, we multiply by the amount you have purchased from them. Okay, so let me just call it purchases. I'm not sure what time can use here, but I want you to look at purchases. The amount the company purchases from those suppliers, whoever it is. Okay, and purchase on credit. Okay, we can qualify here to be purchased on credit. The amount the company buys from them. Whether service, whether material, whether electricity, water, okay, whatever it is. So if the supply for material, okay, the company 2 months, so 2 out of 12, times the amount the company buys for material. In a year, the company buys from them 30% of the turnover. So 30% of the turnover, 15 million. To give us how much?
750,000.
750,000. Let me just confirm that. 750,000. $15 million. So here, I guess 750,000 to be the amount the company owes the direct material suppliers. Then you have suppliers for labor. Okay, so suppliers for labor, and we get how much the company owes them. So not 4, it's 1 week. So 1 out of 50. So they're weeks. They're in weeks now. Okay, in a year we have 50 weeks. So don't convert by just use they are given. Okay. So 1 out of 50, because we are near 50 weeks, we multiply by the amount the company buys from them. That is service they buy from them, 25%, okay, times 15 million.
Of turnover.
Turnover. And you get how much?
You get
3,750,000.
3 million.
Oh, sorry.
75,000.
25,000. And you get 75,000 to be the company, the amount the company owes the employee at any point in time, 75,000. Okay. Then you have suppliers for what's the supply? Variable overhead. Okay. You call them variable overheads. Suppliers for variable overhead. Okay. And they pay them after 1 month. So 1 out of 12. We multiply by the amount the company buys from them, which in this case is 10%. Okay. So 10% of the turnover, 15 million. Give us how much?
Give us 125,000.
125,000. Let me confirm that. They give us 105,000. Yes, give us 125,000 to be the company, the amount they owe the variable overhead suppliers. Then the company also owes the fixed overhead suppliers, and they pay them after 1 month. So 1 or 12, you multiply by the fixed overhead, which is 15%, okay, times 15 million. And you get how much?
187,500.
187,500. Confirm that. $187,500 become therefore the amount the company owes the fixed overhead supplier. Then you have some other suppliers here, the selling and distribution. Okay, selling and distribution suppliers. The company pays them after half a month, 0.5, therefore, okay. We multiply by the proportion of the amount the company buys from them, 5% of 50 million. Give us how much?
31 to 50.
And you get that 1 to 50 shillings. That 1 to 50. And you're done with the working. There seems to be no cash here. There's no note that tells about cash.
There's no cash.
Okay, and that is it. You have done your workings, so you can prepare the company, this stores company, okay, stores limited, okay, working capital statement was still working capital, okay, working statement, working capital statement was still working capital. Okay, that's a better term. Statement of working capital. Statement of working capital. Okay, so it can be in current assets. So you can begin with inventory. And for this case, inventory, we have raw material. This company it's involved in manufacturing, so it has raw material. It has raw material, which raw material is equal to 1 million. Okay, it has work in progress. It has recall my workings. Okay, it has finished goods. Okay, markings here already. Then it has debtors receivable from working, so you just call a working, which we have already done. There's no cash, so therefore the total current assets. Okay, therefore gives me 5.4 million to be the company total current assets.
Yes.
Okay, then we less payables, current liabilities. Less current liabilities. Okay, we have payables. Okay, payables, and the payables here, they are distinct. We have suppliers for material, suppliers for direct material. Okay, so I simply go to the workings. So I'll subtract because it's negative. Okay, because it's cash outflow. Because this is not cash outflow. Okay, this is payables. It's part of current liability. Okay, suppliers for labor. Okay, negative, supply for labor, I have it here. Then you have suppliers for variable overheads and the amount the company owes them, which is equal to 125,000. Suppliers for fixed overhead, which is equal to 110,000. And you have suppliers for the selling and distribution, which we got 31,250. Then therefore, don't forget net working capital is simply current assets minus current liability. Okay, therefore net working capital, and I can just have here total current liability. No need for it, but just put it down. So you can here you have some. $1 million and 160,000.
750.
750. Thank you. The cost working capital, net working capital, is simply getting the excess of current assets over current liability. So therefore, it to be equal to
4,300,000.
4 million.
300,000.
4,300,000.
Okay, 4,300,000 for the company net working capital, and that's what you are required to have done in that particular question. Clear? Question? Okay, see, there's no question. Then I guess we can end the class there. We meet on Wednesday. We finish up on working capital management. Okay, we have a small bit of working capital which we are yet to finish, but I guess we will be done by the end of Wednesday. Okay. Yes, Claire. Claire.
Yes.
Yes.
Why didn't we convert the direct labor
Yes.
to be in months so that all the figures are for months? Why did we leave it as week?
Because you've been given the weeks, you can see that they're being told, assuming a 50-week year, can you see that required?
Mm-hmm.
Yeah, you don't need to convert. Because you have been given the weeks, and the number of weeks in a year has been given to you, you don't need to convert it. As I was saying even in the previous example, okay, use the way they are being given, okay, as much as possible. Don't convert them into days, into months. Use the way they are being given. Like for example, for the material, there are 2 months, so don't convert from being month into weeks or from being months into days. Just use the way they've been given. It's much easier. There's no harm, but it's much easier to use them as they've been given to you by the examiner.
Okay.
Yeah, you can convert, but that's an extra work for you, which doesn't add value. Let me put that way.
Okay. All right.
Okay.
Thank you.
Okay. Okay, enough. Then we can meet on Thursday, on Wednesday. We finish up working capital, and I guess we'll start on how to appraisal of investments. Okay. If there's no question, then enjoy your evening and see you Wednesday. Don't forget to sign.
Kindly make the screen clear.
This is clean.
Yes, the table presentation.
The workings of the final answer. The workings, I don't know.
Yeah, in form of the table, the statement of working capital.
Or share the document at the group.
Oh, maybe let me just share. Let me share in the
share
group.
the document at the group.
Okay, fair enough. Let me share it in the group.
Okay.
Okay.
And also, is it possible to get the links of the previous classes?
Yeah, I know. I have the videos with me. The issue is that I have not uploaded them online, but I have the videos with me. I know I've been a bit lazy on my side, but I will avail them.